Welcome to the Dakota Live Podcast. I'm your host, Robert Morier. The goal of this podcast is to help you better know the people behind investment decisions. We introduce you to chief investment officers, manager research professionals, and other investment leaders in our industry to help you better know the people behind the process. If you're not familiar with Dakota and their Dakota Live content, please check out Dakota.com to learn more about their services. Before we get started, I need to read a brief disclosure. This content is provided for informational purposes and should not be relied upon as recommendations or advice about investing in securities. All investments involve risk and may lose money. Dakota does not guarantee the accuracy of any of the information provided by the speaker, who is not affiliated with Dakota. Not a solicitation, testimonial, or an endorsement by Dakota or its affiliates. Nothing herein is intended to indicate approval, support, or recommendation of the investment advisor or its supervised persons by Dakota. Well, we are very excited to be reissuing one of our past episodes. Jennifer DeSisto, Chief Investment Officer with Anchor Capital Advisors, joined us last spring. Before we share that conversation with you again, we want to remind you that Dakota's podcast platform is growing. The Dakota Rainmaker podcast, hosted by Guy Costin, CEO of Dakota, offers a unique look into sales strategies from top industry executives. Each episode explores the inner workings of successful sales organizations, from philosophy to execution. This podcast is essential for sales professionals seeking wisdom from the best in the field. Please subscribe to our YouTube page at Dakota Rainmaker Podcast or visit Dakota.com to watch all of our amazing interviews. Keep checking Dakota.com for updates and new releases. A few of our more recent were conversations with Jamie Case of HarborVest, Eric Sutherland of PIMCO, Steve Ford of GQG, Adam Bobker of Fortress, and Matt Whitkos of Eaton Vance. Also, don't forget about Dakota Cocktails. These are premier networking events for investment sales professionals. The events are designed for you to grow your connections with local investment industry professionals. Register for an event in a city near you at Dakota.com. A few upcoming events are in Dallas, Texas on February 8th at 5:30 p.m. at Park House, in Boston, March 7th at 5:30 p.m. at Tuscan Kitchen, and in Park City, Utah, March 14th at 5 o'clock at The Spur. We hope to see you there. Again, I am very happy to reintroduce this episode to you with Jennifer DeSisto, Chief Investment Officer of Anchor Capital. Before we share the episode, we're going to remind you of her background once again. Jennifer DeSisto joined Anchor Capital Advisors in 2016 as portfolio manager for their multi-asset class solutions business. Over nearly 8 years, Jen has progressed to the firm's Chief Investment Officer seat, and we are thrilled to share her stories and experiences with you today. Jen's responsibilities include, but are not limited to, manager selection, asset allocation, business management, and product development for Anchor's $7.4 billion in assets under management as of September 30th, 2023. Anchor Capital is a Boston-based registered investment advisor managing approximately $4.9 billion with external managers across all asset classes and an additional $2.5 billion in fundamental, in-house value-based equity and fixed income strategies. Founded in 1983, Anchor Capital is the 10th largest investment advisor firm in Massachusetts and the 47th ranked financial advisory firm in the United States, according to CNBC. Prior to joining Anchor, Jen was the head of manager research for the Fiduciary Trust Company, an $11 billion private wealth management firm that focuses as an outsourced CIO for endowments, foundations, small pensions, and families. Jen and the team at Fiduciary Trust utilize an investment process combining individual equity and fixed income securities with an external manager program during her time there. Jen worked with Battery March as a portfolio manager for global equities, responsible for managing $5 billion in global equity products and an additional $2 billion in U.S. small cap. Some of you will know Battery March, a $20 billion global quantitative institutional investment manager that was folded into QS Investors in 2013. Jen worked with Fleet Bank Bank Boston for 5 years as a vice president in their global capital markets group and began her career at Citi in New York. Jen received her MBA from MIT Sloan School of Management and her BS in Finance and Economics from Carnegie Mellon in Pittsburgh. Jen is a CAIA and CFA charter holder and a board member of the CFA Society of Boston. Finally, Jen is actively involved with the Newton Country Day School and Perkins School for the Blind as a member of their respective board of trustees. She is also an MIT Sandbox mentor and investment committee member at both the Dedham Country Day School and Economic Mobility Pathways. We hope you enjoy this re-release of our conversation with Jen DeSisto, CIO of Anchor Capital. We also hope you tune in next week as we continue our conversations with leaders in our industry. Thank you for being a part of Dakota, and thank you for investing your time with us. So we first met over a decade ago. You were beginning your career with Fiduciary Trust, if I remember correctly. You had just left Battery March after many years of direct portfolio management. So when you think back to that transition from the portfolio manager seat to the asset allocator, what skills did you bring with you to that new role? Thinking about asset allocation and manager selection for the first time, where historically it was traditional stock selection.
Yeah, it was an interesting transition for me because I had never done any of that. I had never done any asset allocation or manager selection. So I came into Fiduciary Trust kind of with a clean slate, which was actually pretty fun because I think the firm itself was undergoing a transition. It was kind of a very old school firm that had been around 130 years, really focused on stocks and bonds. And they were really trying to shift more into building out their external manager program and really thinking about adding alternatives and private investments. And so it was a really fun exercise for me to kind of start from scratch and build all of that out. At Battery March, I was a quant. I was on the PM on the global equity team. And I think, one of the things that I took away from there, stocks really sort of don't matter. It's actually more an exercise on portfolio construction and risk. And I think those key things were really helpful for me to kind of take through and think about building a multi-asset portfolio. How do I think about the portfolio construction and risk elements of that? The other things that I took away from Battery March, I spent some time doing research on factor decay. So I was able to understand how different factors worked and the alpha generated at different points in time. And I think that really has helped as I think building out multi-asset portfolios. And then we were the early days at Battery March focused on ESG, right when all of these independent data sources for ESG were out there. And, we had to kind of figure out how to put that all together and combine it with our alpha model at Battery March. And so since then, I've been able to kind of look at different ESG products and, take what I've learned back then to apply in thinking about building out ESG, both at Fiduciary Trust and now at Anchor. So a lot of things I kind of adopted and carried along since those Battery March days.
Oh, that's so interesting. Well, we'll definitely be talking more about ESG and the proliferation of ESG strategies. That's interesting how far back you go. I mean, it seems like even though we talk about it almost incessantly at this point in terms of thinking about ESG as a way to integrate different metrics into your portfolio from a sustainable perspective, but to hear that you've been doing it now for well over a decade is interesting and exciting for us. So we appreciate that background. Well, you started your career working on leverage buyouts and distressed investing, which gives you an interesting experience and background as it relates to working with companies directly. So as you were engaging with companies on their strategy, were you able to carry that engagement skill set, really working directly with the names in your portfolio when you were at Battery March? It's interesting now that you say that you had ESG as well. So was there direct impact engagement that was involved in the way that you approached your companies, even though you were more quantitatively focused?
Yeah, I mean, it's interesting because I think, when I was doing kind of the leverage buyout, distressed investing piece, it was really, we were underwriting deals going into 2000. And, that was a very hot market. There was a lot of loose standards at that point. And then after the dot-com bust and 9/11, I had to restructure a lot of those deals. And so I learned a lot. I learned a ton during that time. It was really fun too, because I worked a lot with both the companies themselves, the CEOs and the CFOs. Every week I'd be on the phone with them, walking through their cash flows, talking through about where they could spend money or not spend money. And I also had to work with a lot of the private equity sponsors and a lot of the debt holders to kind of restructure the capital structure during that period of time. So you kind of really learn about where you are in the priorities of the capital structure and how to negotiate through really challenging situations. I would say, coming out of that, I've really learned a lot about, thinking about, again, risk and underwriting, stress testing models. I think that was a huge piece. It's, we really try to underwrite a lot of our investments towards, what's, cutting the EBITDA, higher interest rates, all of these things that kind of can impact a company in a distressed situation, and really try to underwrite towards that. And from an ESG standpoint, those were, people weren't even really thinking about ESG at that point. It wasn't until kind of I got to the Battery March that all of this proliferation of data started coming out. And there was all these little data providers. And so we kind of utilized that information to kind of build out an ESG strategy at Battery March. But it was a combination of kind of thinking through risk and stress test and cash flows, and that carried through to the Battery March side. And that's ultimately why they wanted me to come on board, because they said, we can teach you how to program. We just want that fundamental knowledge of working with companies and how we can apply it to our quantitative models.
That's interesting. And I would assume you carry that into fiduciary trust. So you've been a trusted allocator now for many years on behalf of your clients as it relates to external managers. But you're back in this kind of dual seat. You've got the portfolio management side of the business, which is roughly the $3+ billion, and then the external managers, the $5+ billion. So how do you balance the two worlds?
Yeah, they kind of complement each other in many ways. And so I find like I have a breadth of knowledge about both sides that I think really is helpful. I can kind of take a top down and a bottom up approach. With the stocks themselves, we're looking at valuations, we're looking at where there's growth, we're looking at balance sheets, what sectors and industries are doing. And I think that's really helpful when we're, flipping it on its side and thinking about asset allocation, and how we are going to, allocate across different asset classes. Also, a lot of our inputs into the asset allocation process, do they make sense based on what we're seeing sort of on the stock side? So there's a lot of complementary things that happen between the, stock selection process, but also the manager selection side. And I think it also allows me to have some really good conversations with the external managers as well, because I do have this kind of breadth of knowledge. And so, when I'm sitting down, both with public markets and private markets, I'm able to kind of talk through a variety of issues, really drill down to understand their strategy. And I think they appreciate that. I think it's a better conversation because I do have that level of knowledge from both sides of the business. And it's right now, it's a really interesting environment because for the last decade, we've been in a low interest rate environment. And, a lot of things worked in that environment. And so I think we're in a really interesting transition from the standpoint of, okay, in this higher interest rate environment, what investment strategies work and why? And what's the returns and risks look like from here? So I think, it's helpful to have that kind of balance and critical thinking when you're looking at investments these days.
Yeah, it makes a lot of sense. I think particularly for your clients, is we're, as you said, arguably going into an environment where the landing isn't going to be as soft as I think many of us would have hoped. So as you're working with your clients and thinking about, the combination of the external and the internal, where do you see clients, temperature, if you will? So thinking about what last year looked like, where arguably everything kind of correlated into a one. It became very difficult to find diversification. It seemed like everything fell apart essentially at the same time. This year, we've seen some dispersion, thankfully, between asset classes. But as you're going into this new year and you're speaking with clients across the spectrum of your business, where do you see that level of, like I said before, temperature with your base?
Yeah, I think we've trained our clients well, which helps a lot. I think they are being more tilted towards value overall as a firm. I think has really helped, especially in this current environment. But I think what we try to do is build diversified portfolios. We try to manage risk and protect on the downside. And so our clients expect us to perform much better in down markets. I think we've kind of built this let's build a smoother ride experience for them where, they expect us to participate on the upside, but definitely protect and limit the downside for them. And so, between our stock portfolios we build, which, tends to be low vol, low beta type of strategies, and our full multi-asset strategies where we really do try to protect and balance that downside pressure in portfolios. I think our clients, have been pretty happy. They look to us to be the sleep at night manager for them, and provide them a solution where they don't have to worry about us. And I think that's been over the history of Anchor's. Over the history of Anchor, that's what we've done for our clients, and they've been very happy. We've had people around for the entire 40 years we've been here. So I think, in this environment, we also have to look at, are there opportunities out there for clients, given the drawdown in the markets? And we're, not just kind of hunkering down and hiding. We're seeing where there's opportunities out there. And I think there's some exciting opportunities out there for people.
Well, I know Andrew's biting at the bit to ask you about some of those opportunities. But before we do, I read you describing Anchor Capital as having a founder's mentality. After the firm's employees reacquired the business with a local private equity group back in 2018. Can you tell us about the importance of independence when advising client assets and how Anchor approaches those client partnerships? It sounds like there's a lot of education involved, but for our audience who may be less familiar with Anchor, we'd love to hear how your firm approaches, kind of those client relationships and how you think about your business. Yeah,
I think for us, being independent allows us to focus on our clients and really do the right thing for them. So that's, I think we have always tried to make sure that we act as fiduciaries for our clients. And I think being independent allows us that. We're not forcing any particular strategy or type of investment on people, which I think is important. Our clients do love us because we've been consistent over time. And I think that's been important. They call on us for everything. So it's that closeness of relationships that we've had over time that I think has really helped. When we work with outside managers, we really try to find managers that fit a specific role or provide a specific solution into the portfolios. I'm trying to manage risk at the overall level, but I look for different types of managers that can perform at different times in the portfolio. So we're not trying to overload all value into our Anchor portfolios. We really are trying to find a balance of different types of managers that can perform at different points in time in the portfolios. And the other element that we really look for with our external managers is building relationships. I think that's critically important. I think when you have those relationships with these managers, it's able to, you're able to add things to portfolios that may work in certain environments. And we have one particular manager that I've worked with for a decade in the managed futures space. And, it hasn't worked all the time, but in last year, it definitely performed exactly how we expected it to. So, having those relationships has been important. Educating our clients about why we have things like that in the portfolio is pretty important. And it just helps build confidence with that manager, that you have these relationships over time, that you can kind of call on them for information and industry information and asset class information. So it's been helpful from that perspective. I'm working with a new private equity manager right now, and I think they're a little bit frustrated because, I haven't signed subscription documents right away. But I think, for me to see how we work together and see the deals that they're working on and executing on, how they're structuring them, gives me a lot of confidence in what they do. So I think, it's a combination of things that we look for in working with our managers, but I would say, building that trust over time is hugely critical for us.
Jen, could you talk about how you're utilizing active managers? Are there areas where you're just using passive? And maybe take us through your typical underwriting process, how you source, what the typical due diligence process looks like from Anchor Capital's side?
Yeah, I would say, we kind of have a process around if we're going to use passive, we don't think there's a lot of alpha opportunity in that asset class. There's certain segments of the market that we think that there's very limited alpha opportunities. And so we just take beta exposure through an ETF. But overall, I think the philosophy of the firm is very focused on active management. We believe in active management. And so we do try to find managers that generate risk-adjusted alpha and that are consistent over time. And, it's not just looking at a manager at a point in time. I think, there's, particular challenges of like people all chasing the hot dot. So we try to avoid doing that. We try to really focus on, what role that manager plays and also how they perform over a market cycle versus, looking every single year how they're performing. And so, we do a typical, search for an investor. We go through the quantitative process, narrowing down the managers and then doing more of a qualitative process. But I would say the other element is, as I mentioned around relationships, I'm constantly meeting with managers, talking to them, and getting to know them. So when we are doing a search, we do have options, because it's, the quantitative screens are helpful, but if you have met people that you find interesting or you think could fit, a very specific role in the portfolio, it's nice to always be able to include them as part of the search process. So, we try to kind of blend the two. And I think that's been really helpful over time because it kind of allows us to have some interesting managers in the portfolio.
Jen, how do you typically source those managers? It sounds like it may be coming in from all different areas, references, databases. But if you had to, think about kind of your typical sourcing process, if there's a new search that's coming up online, what's the first step?
Yeah, I mean, when we're sourcing a new manager, I would say, definitely we are using the databases quite a bit. That's a first step. It definitely helps. I think it's always interesting when you're kind of doing very, very specific searches. Sometimes managers that they might not be classified correctly in the databases. So especially, things around ESG and more niche-y type of areas. So, we're always trying to keep track of what's coming out of the databases, but also people we know that, might have something interesting to offer. We definitely use referrals from a number of people. Boston has got a lot of collective wisdom around manager research. So, and people definitely have their thoughts and ideas around that. So, we take that list and we go through and try to figure out what selective group of managers that we want to actually spend some more due diligence on. And, typically we're really trying to look for managers that have lower turnover. We have taxable clients for the most part. So, managers with lower turnover is important, who tend to be a little more concentrated. I would say we're not looking for, the manager with thousands of stocks, or hundreds of stocks. We're looking for, more concentrated alpha generative type of managers. And we're open-minded. I think, when I was at Fiduciary Trust, we were very biased against large shops, and very focused on smaller shops, which I think was really helpful because it kind of really narrowed our mandate, to, a very specific group of people. But in this environment, we kind of at Anchor, we've opened it up. So we're open-minded about large shops versus small shops, but I do say we kind of lean more towards smaller and mid-sized firms overall.
Jen, one follow-up to that question, which is vehicles. How do you all typically access an investment strategy, whether it be separately managed account or mutual fund or LP? What's your preferred investment vehicle for implementation?
Yeah, so we've, kind of run the gamut with the vehicles that we can utilize. I think when we look at the private space, we've tried to kind of steer more towards using iCapital for facilitating the LP process, because it's just more centralized. We don't have a lot of back office support for managing subscription documents and building that out. So we've really kind of utilized some of these platforms in particular. A lot more of the GP is building out things more for RIAs and wealth management. So that's really helpful. There's now a lot more vehicles that are, tax 1099 taxes and versus a K1, or they're making, interval funds or BDCs that are really easy to access for clients. So I think, we can utilize pretty much anything, but we're trying to make sure from a back office situation that we're not overwhelming our staff here, and trying to utilize some resources and platforms that make it easier.
Jen, you mentioned small managers. Do you consider emerging managers as part of that small manager bucket, if you will? So, managers with less than $1 billion in assets under management, maybe they outsource, a lot of their kind of core functionality away from investment management services. They're, outsourcing back office, middle office types of functionality. So where does the emerging manager kind of space, I guess, if you will, sit within Anchor's construct?
Yeah, it definitely fits into our ecosystem. We're a founder-led firm, and the founders of the firm are very supportive of looking at emerging managers. So we've done that, selectively over the years, and we really try to find managers that we think have kind of a distinct edge and have kind of a distinct strategy that we can offer our clients. So it's, we're constantly meeting people. And so we're, adding people to that emerging manager list of people that we would like to add to the portfolios. We kind of track people for a little bit to see how they're performing through different environments. We, also provide any support we can, offer them as far as, introductions so they can build their portfolios and build their asset size. And potentially sometimes we've offered some back office support if we think that there's a manager that, might be complementary to our lineup of offerings as well.
And Anchor probably has a unique ability to do that given your managed internal strategies as well. So that is interesting.
Yeah, and one of those internal strategies is I think it's the founders microcap strategy, which I thought was interesting too. Just thinking about kind of the newer managers, the newer companies, unknown companies. So it sounds like that philosophy is embedded, which is really interesting and exciting to hear, I think, for asset managers who are looking to get off the ground. So thanks for sharing that. How about the public markets to private markets, just the mix, the asset allocation mix? As you're thinking about private market opportunities, there's no shortage, obviously, of talk in the markets, whether it's private credit or private equity. So where is Anchor today in terms of the opportunities that you're seeing as it relates to the private versus the public market asset allocation mix?
Yeah, so when I joined Anchor, we really didn't do anything around private markets or alternatives. So I've really been building that out over the last few years. Our asset allocation currently has about a 25% allocation towards the private markets. And that includes everything from, private equity, private real estate, and private credit. So, we're kind of, it's a large bucket for a lot of strategies, but, and I'm hoping as we kind of evolve our process that mix will sort of get larger, because I do think there's a lot of opportunities on the private side that are out there for people. So, we've been kind of over the years just building that out, meeting with a lot of people, really trying to partner up with some firms to kind of add strategies that we think will be beneficial for the private clients. I think on the private side are very focused on the institutional, but there's definitely been a huge shift towards side, and I think that's great. And now there's opportunities for the wealth side that we haven't really seen in a long time. So it's an interesting place but you have to weed through a lot of managers and try to figure out what's the best fit for our type of clients.
And what did that idea generation process look like when you came into the CIO role and relative to today? So as you're thinking about working with your colleagues, thinking about that asset allocation mix, increasing your exposure to private markets, could you just talk a little bit about the the process that's in place between you and your team and how those decisions come to be?
Yeah, when I first came on board, and something that we utilized at Fiduciary Trust was a macro dashboard. And we really kind of separated things by geographies, asset classes, and style. And then we also kind of broke it down more into metrics across valuation, sentiment, technicals, and macro. And we really kind of built that out. So when we do meet, the investment committee meets fairly regularly. And we go through that dashboard to see what's attractive out in the market from all of these different signals that we've built into this macro dashboard. And that kind of helps us think about, okay, where are there opportunities out there? What do we want to do some more research on? Where do we want to spend our time? And then we also kind of discuss, existing searches. If we're replacing a manager or doing a new search, we have that at the investment committee. But I do think, having kind of a framework for, okay, where are there opportunities out there really helps us kind of narrow our focus and allows us to kind of be, especially with a small team, allows us to kind of really spend our time in the right place.
Well, the natural next question to that is, where are the opportunities now, and which asset classes are you currently thinking about as it pertains to those clients that you're working so closely with?
Yeah, I think for us, we think about kind of three different buckets, I guess. One bucket is, I think, structural winners. Where do we think that there's going to be the most opportunities out there from a structural growth perspective? And, like right now we're looking at a lot around artificial intelligence. The ChatGPT is really interesting. We're trying to understand that better. Things around robotics are really interesting. Things around the energy transition and renewables and battery storage, I think, are also really interesting. So that's one kind of category that we look at, is the structural growth. The second category that we look at is, things that low valuation, out of favor. And so one of the parts of the market that we've been kind of paying attention to has been emerging markets. We think that there's opportunity that we haven't seen in a long time in the emerging markets. So we're really been kind of exploring that and looking at managers in that space. And I think the final area is things that, might have been hot but are kind of perceived out of favor, but might be interesting. I like private credit. I started my career doing leverage buyouts, so I know those cycles, those credit cycles, those debt cycles. And I think right now is probably a great time for underwriting new deals, because people are probably super cautious. Interest rates are higher, so you have to build in that cushion into your underwriting. And you're getting a better yield on your debt investments. So I actually think it's a much more interesting time on the private credit side than we've seen even in the last several years, when underwriting was much looser and you could potentially walk into some higher risk with that. So we're looking at some private credit managers as well right now.
Well, you opened up by talking about ESG, and so I think it's appropriate just from an asset allocation perspective. And as you're thinking about manager research, closing with ESG and DEI, so can you talk a little bit? You've named some actually very interesting opportunities. Starting with those structural winners all the way through private credit. How would you, I guess, categorize ESG as part of that framework? So does it sit as it's a standalone asset class, or is it integrated into all of these opportunities that you're looking at? And then probably aside to that is the DEI component.
So it's interesting. I mean, I think some clients are fully embracing ESG, and they want their whole portfolios to reflect that. And I think then we have other clients who want nothing to do with it. So I think there's two elements of it that, we're trying to balance as a firm. We as a firm have a client in France that requested us to develop a sustainable strategy for them, and we did. And as a result of that, we became a UNPRI signatory. We report all of our ESG metrics as a firm, and we also look for managers that have similar characteristics and reporting that we do. And so we do have certain strategies and certain multi-class solutions that are heavily ESG influenced and focused along those lines. And then we do have other solutions where it's less of a priority. So, but as a firm, we've decided, this is an area of focus for us. We have kind of three key sustainability targets. One's around climate. Another one is around human rights, and the other one is diversity and inclusion. And so we've been focused on that at both a board level and a company level, the senior management teams. And we've been pushing that. Those have been issues we've actually been talking about with companies for a long, long time. It's actually, interesting for us because now it's much more formal, and everybody knows that we're doing ESG work. So they call on us and they want to bounce their ideas about their policies and what they're doing with us, which I think is which is great to see the kind of the transition of companies going that direction.
Well, we have a lot of listeners and viewers who are in the earlier stages of their career. And I was reading an interview you gave with MIT about two of your mentors, former board members for Anchor, who advocated to your CEO to promote you to CIO. Can you tell us about the role that mentors have played in your career and, what you learned through that process of assuming the CIO seat?
Yeah, I mean, it was great for my board members. They were very supportive. They saw all the work that I was doing at Anchor and how involved I was across the firm, not just on the investment side. And so they really felt that it was important that I assume this position because I had been doing a lot of the work already coming into it. And over the years, mentors have been tremendous. I think, every step in the way, there's been a person or groups of people that have really kind of helped support me, and both on the investment side, but also building my leadership skills and confidence. When I was at Fiduciary Trust, I worked with an outside manager and the CEO, and I worked on a project together, and he was incredibly supportive and really gave me the confidence that I could do it, and I think that, have somebody at that level to kind of say, I see you have the capabilities to do this. And so I think that's half the battle is like giving people the opportunities, but also just giving them the confidence and support that they need to be able to be in that role. Now as a CIO, but also even before I was CIO, I've worked with my junior analysts, I've worked with interns and even students reach out on LinkedIn, and I've met with them for coffee and we talk investments and talk about their. And so I do think it's very important as a senior person, in the investment world to be able to kind of keep promoting and helping support, bringing people up through the industry, which is a lot of fun too.
Yeah, I think that's wonderful, Jen. Thanks for sharing that. I think I know at least for my students at Drexel University, I better make sure I don't give them your email because they'll be hitting you up for coffees in Boston more often than you could imagine. Well, it's been over 10 years and I enjoyed this conversation as much today as I did a decade ago. So thank you so much for making the time for us, sharing your thoughts and experiences. We are happy for your success and we wish you nothing but more of it as you go forward in your career. So thank you so much.
Thank you. Thanks for having me. It's been great.
Absolutely. Thank you. And Andrew, as always, good to see your face on the desk.
Great to be here and great to hear from Jen today. I think it's interesting. There's these firms you think in your head of as internal managers, like you think of Brown Advisory or William Blair, but they actually have big divisions within that firm allocating to external managers. And, that seems like the case here with Anchor, and what a great firm you built.
Well, if you want to learn more about Jen and Anchor Capital, please visit their website at www.anchorcapital.com. You can find this episode and past episodes on Spotify, Apple, Google, or your favorite podcast platform. We are also available on YouTube if you prefer to watch while you listen. And finally, if you would like to catch up on past episodes, check out our website at dakota.com. So Jen, thank you again. We really valued and welcome the opportunity. Andrew, as always. And thanks for tuning in.
Don't say goodbye.